Okay, so far we have dealt with spreads of options with different strike prices combined according to different coverage ratios, but always all with the same maturity. Vertical depth and credit spreads, as well as ratio spreads and back spreads, which we will see in the next lesson, offer a managerial advantage that the horizontal and diagonal spreads, which we will see in the next slides, do not offer. The certainty of the payoff at maturity. Since all the options involved in fact have the same expiration date, the final result according to the price of the underlying is a certain fact. You can draw the payoff without any doubt. This makes it possible to define management policies for specific situations that will occur during the life of the strategy based on the precise knowledge of the effects of any correction being made to the initial positions. A calendar spread is, as the name suggests, a spread of time. Options are negotiated, some bought, others sold short, which have different maturities. If you combine two calls or two puts with the same strike but different maturities, then we talk about horizontal spreads. If the pairs of options of the same type have both different maturities and different strikes, then we speak of diagonal spreads. A calendar or horizontal spread is a spread made of two options of the same type, call or put, having the same strike but different maturities. For example, you can combine a 21,500 call on the FTSE index expiration. These data are old, but it doesn't matter. September 2015, and a 21,500 call expiring in October. Same underlying, same strike price, same type, both calls, but different expiration dates. One September, one October. One bought, the other short sold. Although theoretically both combinations are possible, typically you go short on the nearest maturity and long on the farthest one. Let's look at the practical example, compare the payoffs, and then make all the assessments. A fundamental premise, since the two options have different deadlines, the question that arises is at which of the two expiries should the payoff be drawn? Given that only one active option remains on the second expiration, the only deadline on which it makes sense to do performance analysis is the first. But this presents a considerable problem. The payoff of the expiring option is certain, but that of the option on the next expiry is not, being in effect a curve at now. I already told you in the previous lesson. But since it is a net now curve that must be determined with about a month in advance, then we are faced with a not minor problem, estimating the at now curve of an option that at that moment will still have about a month's worth of residual life. If we exclude any dividends, we consider the interest rate substantially stable after 1 month. We take into account the fact that the strike is fixed and that in 1 month an option that today has 2 months of remaining life will have only one left. Remain two variables, underlying and implied volatility. These are the two variables we have to deal with. The price of the underlying is not a problem since it must not be estimated. We draw the payoff for all the possible values of the underlying and that's it. On the contrary, the payoff serves precisely to establish what the result of the strategy could be for all the possible prices of the underlying on a certain date. The real problem, by now it should be obvious, is the implied volatility. To determine a payoff at the first expiration of a calendar spread, it is necessary to make assumptions about the implied volatility that that option, the still alive one, will have incorporated when the other option will be at the maturity. And given that, depending on different prices of the underlying, there will be different moneyness of the option and consequently different implied volatilities, what is necessary to estimate the current date of the entire strategy is the entire smile or skew of implied volatility that the option on the longest expiration day may have around 1 month forward. It is more than evident a procedure that opens up rather broad spaces of error. Let's proceed with the practical example and then return to the concepts and problems discussed here. The payoff to the September 2015 expiry of a call calendar spread is shown at the next slide. It's made of a September 22,000 short call, 3,050 points the premium collected, October 22,000 long call purchased for 710. The price of the underlying is around 21,950 at the time the strategy was created, so it's a calendar spread at the money. Short on the shorter maturity, long on the longer maturity. Indeed, it's a debit spread because what we pay on the longer maturity is higher than what we collect on the shorter. But at the first maturity, all this premium will be collected. And the question is how much of this premium will be lost, because the differential will be our profit or our loss. So this is the expected payoff at maturity of the calendar spread, made of a short call 22,000 for 350 points and a long call 22,000 for 710, different expiration dates, maturity September, maturity October. This is the expected payoff. Expected because, once again, this is the expected payoff at the maturity of September. In September, this option will expire and its payoff will be for sure a line that we will see in the next slide. The payoff of the option expiring on October will be an hypothesis because it will be an expectation of the at now curve of that option having still a month of residual life. Let's see the legs. Next slide. This is the total payoff, okay, that is made of a short call 22,000 first maturity, whose payoff is perfectly predictable, okay, for all the prices of the underlying, of course, and a net now curve, the at now curve of the long call 22,000 expiring on October. The red line is the at now curve of the total strategy at the moment of the creation of the strategy, the first day, the current day. Okay, so at the first maturity, this will be for sure the payoff of the short call 22,000 expiration September. This is the expectation we can make today of what will be the at now curve of the call 22,000 expiring in October, the day of the expiration of the short call to 22,000 points. Okay, so this is an expectation made on what? On data we know today, and what we know today is a volatility skew that could change significantly over the next month, not only in its horizontal position, depending on the moneyness of the options, but also in the vertical direction, because the shape of the volatility skew can change horizontally, vertically, and also, let's say, diagonally, because you can see the concavity of the curve increase or reduce. So you could have a completely different shape of the volatility skew within the next month. So once again, this line, this green, or let's call it green line, it's just an expectation. So all the payoff of the strategy is just an expectation, but there's nothing you can do about it. You have to do hypothesis. One interesting thing with the calendar spread in respect with the short straddle, which looks very similar to this payoff, is that the short straddle has not a maximum potential loss in the tails of the distribution. The calendar spread here is not shown, but I can tell you, goes away almost horizontally. After a while, the two wings of the calendar spread go away asymptotically with an horizontal line, which usually is set at the same level if the spread is symmetrical. And in this case, it could be around 450, 500 euros here of loss. So here you would see the payoff keeping going down to some point, let's say 450, 500, and then it would become almost horizontal. Okay, this is a peculiar feature of the horizontal spread in respect to the short straddle, which makes it let's say easier to manage psychologically, because you know you're not exposed to an unlimited potential loss. But it is very hard to manage it from a practical, technical point of view, because it's very hard to predict what will happen to the implied volatility of the option that will not expire in the first maturity. What if we offset not just the maturities but also the strike prices? We reach a diagonal spread. The diagonal spread is a variant of the calendar represented by a strike misalignment of the two options traded as well as the expiry. For example, short call 23,000 October, long call 23,500 December. Different maturities, different strike prices. The estimated payoff at the first date is this. And as you can see, is something very similar to a broken wing butterfly. Okay, and this time the advantage of the asymptotically behaving loss, maximum potential loss, on both sides of the strategy no longer remains, because even with let's call traditional broken wing butterfly, you absolutely know in advance how much you will lose in both tails of the distribution if the price goes significantly down or significantly up. The same applies here, but here it is no longer an advantage of the calendar spread, the diagonal in this case. So I must say, in my humble opinion, I am not very fond of this kind of strategy, because I do not see any advantage in this type of combinations, given the fact that they raise too many problems in the managing of them, in their management, due to the fact that we have to make too many hypotheses on what could happen in the future. Anyway, I know that some traders use a lot these kind of spreads, especially the diagonal ones, and especially on stocks that are about to release earnings news, because in those situations the implied volatility on the shorter maturities are much higher than the implied volatility on the longer maturities. So on the option that you short sell, there's a lot of expectation, and it means that you collect quite a very good money amount in respect to what you pay to buy the protection given by the long options. So they could be good strategies in such situations, but the point is, I repeat, in my humble opinion, that they require a very big deal of expertise, because they are absolutely not easy to manage. And I think that an easier broken wing butterfly could provide more or less the same results with much less problems. Okay, one last concept, LIPS. On the American stock market, options, some particular options are listed, called LIPS, long-term equity anticipation securities. These are simply stock options with long-term expiries up to about 24 months. These options are also listed on strike deep in the money and with fairly contained spreads bid-ask. The main advantage they offer is that of opening positions in long-term equities using only a part of the capital necessary for opening a direct position on the underlying. Let me show you a practical example out of the presentation. Let's go to McDonald's, just to say. Let's take long maturity. We could pick January 2021 or even January 2022. Let's pick this. The last close was 195. So let's take, just to say, a call strike 100. Okay, or even a 90 call. Let's take a 90 call. No, I cannot take the 90. Let's take the 100. Okay. The call 100 is quoted for the maturity 2022, which is 774 days from today. It's quoted 93.15, 98.45. Being the price of the underlying 195 more or less, it means that more or less the mean price between the bid and the ask leads to more or less the same price of the underlying in this moment. Assume just for instance that you purchase this for 96.50. It would be like purchasing McDonald's on January the 21st, 2022 for $196 each. And it would mean to purchase it for more or less the same price as today, putting in the plate not $19,569, but only $10,000 in the, but only 9,600 in the very beginning. And then you would have the same advantage of as owning the stock, but using less than half than the money needed to purchase it right away. And what could you do? In the meantime, you could do covered call writing on the same stock, because you would have basically a long call, which you could combine to a short call on a shorter maturity. Let's say, for instance, on the January maturity. And let's take also different strike prices. Let's take some out of the money ones. 200, 205, 210, just to make a few examples. Here, you could purchase today the call lips for $96, let's say $97, okay, which would mean to purchase 100 McDonald's shares for $190 for $100 each, and it would mean to purchase them for $197 actually, because you have the right to purchase for 100, but you paid $97 to have that that right. So in reality, you would pay $197 per share. And in the meantime, what could you do? You would have several months ahead. So every month you could short sell a call with a strike price more or less close to the current value of the underlying, just to say, for example, 200, collecting $1.74, $1.77, $1.78. And what this would mean, it would mean that you would gain, let's call it a dividend, a monthly dividend on the stock that you will purchase 774 days from today, not today. Today you are taking the right to purchase the stock in 774 days. You are not purchasing the stock right now. But at the same time, you are opening a position equivalent to the owning of the stock. So you can do short selling of calls against that. And in this case, let's say you collect 174 out of 97, the money in the plate, and it would make a 1.79% dividend on a monthly basis, more or less. It's not exactly a month, January the 17th, it's 39 days. So let's say that on an annual basis, you could be able to create a monthly flow of dividends of about a 1.5, 1.60, 1.70% per month in dividends on a stock that you are not actually owning right now, but that you will purchase in 774 days, only if it will be convenient for you. So this is a good way of combining options with different strike prices, different maturities, and by all means, I am doing a diagonal spread. But in another way, I could see it also another way, and it could be seen as a long stock plus a short call, and it's a covered call writing, something I already told you about in one of the previous lessons. So this is a way of doing diagonal spreads which I must say I like. For all the other strategies, even those combining different strike prices and maturities on stocks, just to say when a stock is about to release communications about earnings, I would rather do a broken wing butterfly, broken wing butterfly or a broken wing condor, because more or less the payoff is the same. This concludes the part about calendar spreads, and we only have just a few strategies left to see, which I must say I don't like very much, but in order to give you a full knowledge about option strategies, we are going to see them.